Welcome back, everyone. So today we're going to talk about investing for beginners, how to make millions from stocks. We're going to give you the full guide today, okay? So investing is a long-term game for wealth. All you have to do is look at Warren Buffett's wealth building when he started compared to now. Look at the chart. Embarking on the journey of investing in stocks can feel both exciting and daunting, especially if you're a beginner. We get it. So the idea of making millions from stocks is an enticing one, but sometimes people can't imagine it because they don't see it right away, right? But with the right mindset and strategic approach, it is going to be possible for you to grow your wealth through stock investing. If you stay to the end, we're going to give you a few picks that would be great for beginners to invest in. To invest successfully, it's crucial to start as early as possible and develop a solid understanding of the basics of investing. So this includes opening an investment account and selecting an investment strategy, and then exploring various investment options available. A firm grasp of these fundamentals will help you take advantage of the power of compounding and navigate the inevitable ups and downs of the stock market. So as a beginner, expecting to make millions overnight is not a realistic goal. It just is not going to happen, right? But with patience, consistency, and really commitment to learning and adapting, it'll serve for the foundation of your investing journey. So when you invest in stocks, one of the key advantages you have is the power of compound interest. Simply put, compound interest is the interest earned on both the initial principal and the interest that has previously accumulated. In the context of the stock market, this means that the returns you earn on your investments will also be reinvested, allowing your portfolio to grow exponentially over time. Let's consider an example. Suppose you invest $10,000 in stocks with an average annual return of 7%. So at the end of the first year, your investment would have grown to $10,700. That extra $700 is then reinvested in the second year. And then you earn 7% on that new balance of $10,700, bringing your total to $11,449. As this continues, your investment will grow more significantly each year. So here we'll give you a quick breakdown of returns over 5 years in this example. So if you see in this example, you'll see the year, the starting balance, the interest earned, and then the ending balance for each, like year 1, year 2, year 3, year 4, and year 5. Now, if you look, by the end of the 5th year, your initial investment of $10,000 has grown to $14,026. The compound interest earned is $4,026, and your investments will continue to grow at a faster pace as more time passes. So to maximize the benefits of compound interest, you want to follow a few simple tips, okay? Start early. The earlier you begin investing, the more time you have to take advantage of the power of compounding. So both my kids, I've got them set up with an account with a Roth IRA, and we have it in an index fund, right? And they're 18 when we started this. You want to reinvest those earnings. It's another good tip. Ensure that the dividends and capital gains are reinvested, as this will keep you adding fuel to the fire of compounding engine. And then you just want to stay committed. So stay invested in the market even during downturns. That's one of the key things people make mistakes. They don't ride out the market volatility and just sticking to the long-term plan. They just pull their money out and they lose money. Remember, with patience and time, compound interest can be a powerful tool in growing your wealth through the stock market investments. Look at the earlier chart we showed with Warren Buffett. The more you understand how it works, the better equipped you're going to be to make wise investment choices. You want to also try to set up investment goals and defining your financial objectives, like what are you really wanting to do with your investments. Start your journey towards building wealth through stocks. You need to clearly define your financial objectives. Ask yourself, why you want to invest and what your aim to achieve in the long run. Now, some common financial goals that people have is the biggest one is going to be retirement, right? Saving up for a comfortable and secure retirement. Another one is you want to have an emergency fund, building a safety net for unexpected financial crisis. You at least want to have 6-month pay in the bank. You want family planning, ensuring a bright future for your family. You may want to put money aside for education for your children to go to school or college or trade school. You may need it for life events like milestones such as weddings or a vacation you want to take. So make a list of your goals and then your priorities and lay them all out. You also want to know your risk tolerance and time horizon. So understanding your risk tolerance and your time horizon are crucial when you're setting your investment goals, right? What is your risk tolerance? This refers to your ability to handle fluctuations in the value of your investment portfolio. So generally there's going to be 3 levels of risk tolerance, right? There's a conservative, you prefer stable investments with minimal risk, even if they offer low returns. Then you've got the moderate type of person. They can tolerate some degree of risk for higher returns, but still seek a balance between risk and reward. Then you've got the aggressive people. Let's go. Okay, they are willing to accept high levels of risk and potentially larger returns. Now, your time horizon is the period between now and when you hope to achieve your financial objectives. So what is the time period? It affects your investment strategy since different time horizons require different investment approaches. Generally, the longer your time horizon, the more risk you can afford to take. So if you have 40-year time horizon, a lot better than a 20-year, right? So here's a rough guideline. Short term is 1 to 3 years, ideal for the conservative investments like money market funds or fixed income securities. Medium's going to be like 3 to 10 years, suitable for a mix of conservative and moderately risky investments such as bonds and certain stocks. And then long term is going to be like 10 plus years. I would even say even like 20 years. Allows for a higher exposure to riskier investments like stocks and equity mutual funds. So to effectively set your investment goals, take the time to evaluate and understand your financial objectives, your risk tolerance, and then what your time horizon is, right? What we just talked about. So by doing this, you'll be better prepared to make really good decisions, which stocks you're going to invest in, and then create a personalized investment strategy that's going to be, fit your needs. But before you jump into the stock market, it's important to learn how to analyze stocks, right? So you want to start by researching companies you're interested in. So that's what Warren Buffett did. He only invested in companies that he knew about, like Coca-Cola, things that he was familiar with, insurance. So you want to look at their financial statements. You want to evaluate their growth potential. Do they have good leadership? We suggest using an online investment account to practice investing in shares of stock or stock mutual funds. You should examine the key financial ratios such as the price to earnings, P/E ratio, earnings per share, EPS, and the dividend yield. So this is going to help you determine whether a stock is over or undervalued. Now here's a brief list of key ratios to consider. P/E ratio, the price to earnings ratio, shows the price you pay for every dollar of earnings a company generates. A low P/E ratio may indicate a potentially undervalued stock. So EPS, which is the earnings per share, this will show you how much profit a company generates per, outstanding share of its stock. Consistent growth in EPS is a good sign of a healthy business. And then you want to look at the dividend yield, right? So dividend yield measures the annual dividend payments relative to the stock price. The higher the dividend yield can indicate a more stable and mature company. Now, diversification and asset allocation. So diversification is the process of spreading your investments across various asset classes and industries and regions to minimize your risk. A lot of people do this, right? I even do this. Asset allocation refers to the proportion of your investment portfolio dedicated to different asset classes such as stocks, bonds, and cash equivalents, right? So according to Harvard Business Review, making smart investment involves spreading your capital across a variety of ventures, thus reducing your risk while increasing the potential for reward. So here's a simple breakdown of how to allocate your assets, right? You want to start with a solid foundation. So diversify your portfolio by investing in stocks from a mix of industries, sectors, and geographical locations, right? You can look at index funds or mutual funds or an ETF, right? That's a great way to start. That's what I would advise you to do. Rebalance regularly. So regularly review your assets, allocation, and make adjustments to ensure you maintain the desired level of diversification you want. And then just consider your risk tolerance, right? Is your risk tolerance, it may change as time goes on and you get older, life events. So you may need to adjust that. And then you just got to look at the importance of being consistent, right? So as a beginner investor, it's crucial you just maintain consistent investment strategy and keep investing no matter what. A lot of people just quit and they never pick it back up. And then later in life, they're like, oh, I have no money. So to do this, you just set up a regular contribution to your investment account, like pay yourself first, right? Either through an automatic deduction from your paycheck or by making, a scheduled deposits. When starting your investment journey, choosing the right broker is also going to be crucial. So you should consider a bunch of different factors like their fees and commissions. So just take the time to compare and research multiple brokers to find out which one fits your needs. You can also do what a lot of people are doing and just manage their own portfolio and not even have a broker do it. Because you are going to have to just not give it to a broker and let it never look at it. You're going to have to still look at it. You can't just trust people. You have to make sure that they're doing what's right for you. To execute trades, you must understand the stock quotes. And a stock quote contains important information like the ticker symbol. So that's a unique identifier for each stock. The last price, that's the most recent transaction price of the stock. So the bid and ask prices, this is the highest prices the buyer is willing to pay, bid, and the lowest price the seller is willing to accept. Volume, so the number of shares traded during a specific time frame, that's what the volume is. And then, check out the 52-week high and low, the highest and lowest prices that the stock has reached in the past 52 weeks. That's what that means. You want to stay informed by monitoring the stock quotes regularly and observing market movements. So a lot of people, when they first start out, you'll see they're told invest in a Roth IRA, and I agree. This should be the first thing you do. A Roth IRA is a type of individual retirement account that offers significant tax benefits. So in a Roth IRA, all your contributions are made with after-tax dollars, which means you don't get an immediate tax break on what you invest. However, your investments grow tax-free, and you can withdraw your earnings tax-free once you reach the age of 59 and a half, as long as the account has been open for at least 5 years. Now, some key features of the Roth IRA include tax-free withdrawals. All right? So earnings and qualified withdrawals are federally tax-free. Flexible withdrawals. So you can withdraw your contributions, but not the earnings, at any time without a penalty or taxes. And then there's no required minimum distributions, RMDs. Unlike traditional IRAs, Roth IRAs have no RMDs, allowing your investments to grow for as long as you wish. Okay, so let's go over the Roth IRA eligibility. Not everyone is eligible to contribute to a Roth IRA, as there are certain income limits, right? So for 2023, you can open and contribute to a Roth IRA if your adjusted gross income is, for single filers, less than $138,000, right? And then for a married couple filing jointly, it needs to be less than $218,000. Now, if you meet the eligibility criteria and decide to invest in a Roth IRA, here are some quick facts. The contribution limits for 2023, you can contribute up to $6,000 per year or $7,000 if you're over the age of 50. Income sources, contributions to Roth IRA can come from, a job, or even you can roll over a Roth, 401k. You can make regular contributions. Contributing to the Roth on a regular basis can help you maximize your retirement savings. Now, here's how you can make regular contributions. You can choose a brokerage firm, look for a firm that has a wide range of investment options and low fees like we talked about earlier, and that's user-friendly, like Fidelity, Webull, and Schwab. And then you can open the Roth IRA account through one of them. The process typically involves providing some information, selecting a beneficiary, and linking the funding source like a bank account. Then you just need to select your investments. This might include individual stocks or bonds or mutual funds or, exchange traded funds, ETFs. Many beginners start with a diversified mix of index funds and ETFs to minimize the risk. This is what I personally do investing wise. You can set up an automatic contribution. So most brokerage firms will allow you to set up a regular investment schedule, such as a monthly or bi-weekly deposits. And then it's just, you'll stay disciplined that way. It'll just automatically go into their investment. So let's check out Jason. He was a forward-thinking individual who embarked on a wealth-building journey through, setting up his Roth IRA investing. He started at the age of 25, and Jason committed to, consistently contributing $500 a month to his Roth IRA. So to retire comfortably at 65, he was determined to harness the power of compounding interest, right? So over the course of 40 years, Jason's monthly contributions, totaling about $240,000, grew exponentially thanks to the compounding effect. Now, we're assuming that Jason made an average return of 8% on his Roth IRA, and for his retirement, it ballooned to an impressive $1.5 million. So the tax benefits of the Roth IRA are a game changer for Jason. As he contributed after-tax dollars, all withdrawals in retirement were entirely tax-free. He's not taxed on anything he takes out after retirement. This meant not only did Jason accumulate a substantial nest egg, but he also had the peace of mind of knowing that every penny was his to enjoy for retirement. Jason's disciplined approach to investing allowed him to weather the market fluctuations and economic uncertainties by, reviewing his stuff and adjusting his portfolio as he went through life. He maximized his returns and minimized his risks. Now, this hands-on strategy combined with tax advantages of the Roth IRA played a pivotal role in his financial success to get to $1.5 million. You just need to get started, open an account, and start investing. Do what Jason did, and do what I do, and many others, and start building your wealth nest egg today. So here's a few you can check out. I would check out the Vanguard Total Stock Market Index Fund, Admiral Shares VTSAX. Annualized return is 11.1. His expense ratio is 0.04. Then you have the Vanguard 500 Index Fund, VOO. It's an ETF. And over the past 10 years, VOO has yielded an annualized return of 11.98%. And as of January 2024, the Vanguard S&P 500 ETF has an expense ratio of 0.03%. Now, if you found this video helpful, give us a thumbs up. Hit the subscribe button for more videos on wealth building and making money. And just let us know your thoughts in the comments.